This is Macro Horizons, episode 387, Dear Vol, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Vail Hartman and Delaney Choi to bring you our thoughts from the trading desk for the upcoming week of August 17th. The combination of July's negative payrolls and a benign CPI report has left the balance of August as a period of stability for the macro narrative. Dear Volatility, thanks for the memories. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the most meaningful event came in the form of economic data, specifically core CPI for the month of July printed at just 0.215. Now that marked an increase from June's level, which was negative 0.017, but at the end of the day, the inflation report was benign enough to materially undermine the probability of a September rate hike. Now, it goes without saying that between now and the September meeting, the FOMC and the market will have the benefit of the August data. August data will include both payrolls as well as CPI. That being said, when considering the trajectory of the real economy in both June and July, it's not an issue where we're having a conversation about a single data print. In fact, the trajectory has been more consistent with the Fed starting the conversation about potential rate cuts, as opposed to actively attempting to message a rate hike in September. Our base case remains that the Fed will remain on hold for the balance of the year. A broader reassessment of the prudence of a rate hike or rate cut will come at the beginning of 2027. By that point, Warsh will presumably have the findings of the 5 task forces and will have had time to continue building consensus for any major changes. The most compelling case for a September rate hike at this point would be an outside surprise in the August core CPI numbers, combined with an acknowledgement that it will be difficult for the Fed to justify starting a hiking campaign at the October meeting, simply because the October meeting is just days before the midterm election. Monetary policy history shows that the Fed has been unwilling to shift the direction of monetary policy immediately ahead of an election. Now, that is arguably less relevant for the midterm, but given questions about central banking independence, given questions about how political monetary policy has become, we think it's safe to assume that if the Fed doesn't choose to hike in September, the next truly live meeting will be the December meeting. With this backdrop, the Treasury market has performed reasonably well, all things considered. We've seen yields retrace after reaching local highs, and in part, this is a data story. When we look at the specifics within the CPI release, we see that Supercore, which is core CPI services excluding OER and rent, increased just 0.189% in the month of July. That was an increase from June's decline of 0.2%, but nonetheless, the trajectory remains well within the range that it would be consistent with the Fed's longer-term inflation target. Perhaps just as importantly, the fact that average hourly earnings in the month of July were just 0.1% suggests that there's not a great deal of nominal wage pressure, which would afford consumers the ability to chase inflation higher. There has historically been a high correlation between supercore inflation and nominal wage gains. So if nothing else, the combination of July's data will offer monetary policymakers some solace that we're certainly not facing a demand-driven reflationary environment or are at the risk of a wage inflation spiral.
On the economic data docket this week, we saw the release of July's CPI and PPI reports, and the benign inflation figures underpin the bond bullish tone in the Treasury market over the balance of the week. For context, the yearly pace of core CPI is now back at pre-war levels, and the 3-month average change in the monthly pace of core CPI is at the lowest in the last 2 years. The fundamentals were largely back in focus given the lack of meaningful progress in the Middle East, and stocks are, once again, back at record highs. Overall, this week's benign inflation figures, when combined with July's negative payrolls print, have caused a broad-based rethink of whether the committee will have sufficient justification to hike rates in September.
The price action in the very front end of the curve, I think, is interesting because if we put it in the context of what the market is telling us the odds for a September rate hike are at the moment, which is roughly a 31% probability, that's exactly what was priced in the day before the July FOMC meeting. And it was generally assumed in the run-up to that meeting that the Fed was most likely to deliver a hawkish pause, which arguably is precisely what we got, while the lower probability risk was that they actually hike. Said differently, Warsh's pushback against forward guidance means that the run-up to every Fed meeting, for the foreseeable future at least, should price in a higher probability of a non-consensus outcome than would have otherwise been the case. So in translating this into the price action in the front end of the curve, we might actually be up against the lower bound for 2-year yields unless and until the market is comfortable pricing in no rate hikes for the foreseeable future or even potentially rate cuts. At that point, the price action would be very dramatic in the front end, and we would target a move back to effective Fed funds. But to be fair, there's no conversation about rate cuts at this point, and we maintain that the path of least resistance is still for the Fed to keep rates on hold through the balance of this year.
And beyond the September meeting and looking over the market-implied path of policy rates over the last 3 meetings of the year, it's notable that the October meeting has been trading rich on the fly versus September and December, which in all likelihood is due to the October 28 meeting's proximity to the midterm elections on November 3rd. It's been pointed out that the FOMC might be reluctant to embark on a rate hiking campaign just days before the midterm elections. And so the assumption is that if the Fed doesn't move in September, then the next truly live meeting for a rate hike isn't until December 9th. By then, the Fed will have a few more months of inflation data to better inform its assessment of the true underlying pace of consumer price gains.
For the time being, we expect that the Treasury market will continue to consolidate in the existing range with a bias lower in rates as investors contemplate exactly how high the bar has been raised for a September rate hike. We maintain that the most reasonable path to a September rate hike at this point, given the June and July payrolls and CPI data, is that there's a collective rethink on the part of policymakers regarding where neutral is and an active discussion about taking back the 75 basis points worth of rate cuts seen in 2025 simply to recalibrate policy rates to a level that the committee views as appropriately restrictive given all of the headwinds in the economy at the moment. While this certainly isn't our base case scenario, it is not an unreasonable argument and something that we're reasonably confident has been discussed by committee members. It's also worth observing that the last couple months' worth of data have materially reduced the risk that the energy shock translates through to higher realized core inflation. The longer the conflict in the Middle East persists and the longer the energy prices remain in their present range, the easier it becomes for the macro narrative to shift beyond near-term concerns about core inflation.
And on the topic of the neutral rate, we'll note that 5-year forward real yields are currently at the highest levels in years. Further out the curve, 10-year forward real rates are also at the highest levels since 2001. With the metric currently trading well above 350, 10-year forward TIPS yields are more than 200 basis points higher than the average over the last decade. And the rise in these market-based proxies for R-star have been a key contributor to the ongoing resilience in real yields. This has brought up the floor for nominal yields and contributed to the ongoing bond bearishness in the Treasury market. And there's been multiple factors underlying the concerns regarding a higher R-star. between persistently elevated inflation, global fiscal concerns, loose financial conditions, and not to mention the notion that AI will ultimately increase, not decrease, R star. And that's really a conversation about the ultimate impact of the higher productivity regime that's expected to be brought on by the AI build-out.
There also seems to be an issuance factor at play here in the real rates story. Over the next few years, trillions of dollars worth of AI infrastructure financing is expected to bring substantial non-treasury duration supply to the U.S. fixed income market, with consequences for the outright level of yields as well as the shape of the yield curve and term premium. Thus far, the AI build-out has overwhelmingly been a long-term financing story, and the additional duration supply has resulted in a structural bear steepening bias in the treasury market. Looking forward, heavy AI-related issuance in both public and private debt markets will likely continue to serve as a structurally bearish underpinning for treasuries unless and until we see a slowdown in hyperscalers' CapEx growth, which has yet to become visible on the horizon. All that being said, the traditional macro fundamentals like growth and inflation expectations should remain the dominant drivers of U.S. 10 and 30-year yields.
On the topic of AI's impact on R star, we're aware of the AI equals higher R star argument over time, and it essentially holds that higher productivity will lead to higher profitability will increase the wealth effect, people will then subsequently consume more, and as a result, R star should be higher. The flip side is our stance, and that's that over time, higher productivity will limit nominal wage growth. Nominal wage growth will keep inflation low and contribute to slack in the labor market, and that will lower R star as a result. We're also open to the argument that in the very near term, R star is higher, but over the longer term, it will be lower as a result of the AI build-out. One thing is clear, we have already seen some tangible pockets of realized inflation as a result of chip demand. In the July CPI report, the category of software and accessories, which monetary policymakers have referenced in the past, was little changed, up just 0.5% in July. However, this same series has increased more than 20% year over year. So there's unquestionably some upward pressure as a result of AI activity at the moment. The question clearly becomes, how much further will that dynamic extend in the medium term? For the time being, at least, it appears that forward inflation expectations are safe, or at least contained, given the last 2 months' worth of realized data. On the jobs front, we did see a higher than anticipated initial jobless claims print for the first week of August, but it's still in the low 200s, and in outright terms, it's not concerning. However, the weekly ADP numbers marked the 7th consecutive week in which the figures printed below the prior week. The trend has clearly been toward the downside, and if this trajectory extends throughout the month of August, we could find ourselves with another dismal payrolls print, which will make it all the more challenging for the Fed to consider hiking rates next month.
And it's this backdrop that has helped push two-year yields through the Bollinger Band bottom, which is defined as 2 standard deviations below the 20-day moving average for the first time since April 17th. We'll also point out that the last time front-end yields closed below the Bollinger Band bottom was February 13th, which was before the war began. Additionally, we see both daily and weekly charts skewed in favor of lower yields in the 2-year sector, and combined with the bond bullish fundamentals, we see a fairly constructive backdrop for the front end of the curve at the moment.
And shifting gears to the political front, it's been interesting to see a pickup in discussion about what the war in the Middle East means for the midterm elections. History alone tells us that the party that controls the White House often loses congressional seats as a result of midterms, and the betting markets currently indicate that the Democrats are heavily favored to flip the House in November, and nearly 50-50 odds that the Democratic Party takes full control of both congressional chambers. This begs the question, what are the implications for the Treasury market if Republicans lose their current trifecta of power? On the one hand, midterms could end up having a fairly minimal impact on the Treasury market, as has generally tended to be the case throughout history. On the other, if midterms serve as a catalyst for sweeping shifts in policy that trigger a recalibration of the macro outlook, then one should expect a more dramatic impact on financial markets as a whole. especially if a shift in congressional control leads to a reshaping of the Trump administration's primary initiatives in terms of tariffs, tax cuts, and deregulation.
It is interesting to note that in the event that the Democrats do particularly well in November, that Trump could face some pushback if the Senate flips to the Democrats, trying to appoint another Fed board member if and when Powell eventually relinquishes his seat. All of that being said, the composition of the Fed at the moment appears to be more balanced and responding to the economic data than having any clear bias. Certainly no definitive dovish bias at the moment. All of this sets up the next several weeks to be a period in which the theme of consolidation will run up against the occasional headline from the Middle East or an incremental data point that might reinforce the idea that we are starting to see some additional softening on the labor market front, while the acute period of inflation pass-through to core goods appears to be behind us for the time being.
And it's also interesting to note that the pullback in forward guidance from Warsh has largely led to the market evaluating each incremental piece of Fed speak for whether a policymaker might be voting in favor of a hike or in favor of a hold in September. So rather than the market just reacting to the incoming data, which has largely been Warsh's stated goal in reducing forward guidance, the market has turned to counting votes, as it were.
And in our efforts to read the tea leaves of Fed speak, it strikes us that a majority of the FOMC voters have expressed an openness to raising rates in the near term if underlying inflation doesn't show signs of cooling. Within that majority, we've put Cook, Hammock, Jefferson, Kashkari, Logan, Paulson, and Waller. Even dovish New York Fed President Williams has admitted that it would absolutely be appropriate to act if the economy is not on a trajectory that will bring inflation back to 2%. That being said, we doubt Williams would endorse a hike as soon as September, given his focus on the performance of inflation throughout the second half of this year. And let us not forget a recent article in the financial media that said Fed Chair Kevin Warsh would be prepared to raise interest rates at September's meeting if the inflation readings during the intermeeting period were hot.
And clearly that wasn't the case for July, at least. And that's one of the complexities of the Fed outlook at the moment. Did both July and August need to come in hot for Warsh to endorse a Fed hike, or does just one of these prints need to come in hot? And if August does come in higher than expected, how far above July's core CPI print of 0.1 would the realized data in August need to be to sway monetary policymakers and justify a rate cut at this stage? Well, if nothing else, the Fed watchers will have plenty to watch, even if not much is being said over the course of the next several weeks.
But I thought August was supposed to be slow in the markets.
Fed speak never rests. In the week ahead, we're anticipating that the Treasury market will spend the bulk of its time in a consolidation mode. A consolidation mode with a slightly bond-friendly tone. We do think that as the market continues to price out the probability of a September rate hike, that the two-year sector will perform well. At present, the market has roughly a 35% probability of a move in September priced in, and we anticipate that as the data unfolds, it will become clear that a pause will be the path of least resistance. It is certainly not wasted on us that Warsh's pushback against forward guidance has made the Fed outlook incrementally more challenging. However, we'll argue that the combination of June and July's payrolls and CPI prints effectively speak for themselves, and it would be challenging to envision the Fed building a case for a rate hike based on these 2 months' worth of economic data. The argument would need to be that R star is materially higher, therefore reversing the 75 basis points worth of rate cuts from 2025 is prudent. It doesn't strike us that that argument is being made at the moment. The argument seems to be that because of the energy shock and the risk for pass-through to core prices, that the Fed should consider hiking rates. The June and July data show that that pass-through has been limited. Therefore, the bar is much higher for a hike in September. On Wednesday, the market gets the benefit of the FOMC minutes from the July meeting. Recall that while the FOMC statement has been shortened materially and left effectively unchanged in July, the FOMC minutes that accompanied the June meeting were a little bit shorter than average in length, but nonetheless did the typical job of outlining the broader discussion among committee members in reasonably full detail. So as a result, we'll be watching for details about the debate on the FOMC and the arguments made by the three dissenters who dissented in favor of hiking rates. On the supply side, there are two notable auctions. First will be the $16 billion 20-year on Wednesday afternoon. This will be yet another litmus test for investors' demand for longer duration Treasury products in an environment where there remains a great deal of geopolitical uncertainty as well as uncertainty associated with the monetary policy outlook at the moment. Thursday's $8 billion 30-year tips will be in focus primarily because of how high 30-year real yields have become. 30-year real yields north of 3% are sending a message to the U.S. rates market. That message being that there needs to be more term premium priced in further out the curve. Demand for 30-year inflation protection might be waning on the margin, given that the initial impression of the Warsh Fed was a hawkish one. Now it appears that the interpretation of Warsh is a bit more balanced at the moment, so it'll be very interesting to see how that particular auction is received. As a theme, we are expecting the market to consolidate within the prevailing range. We do like duration. We do expect the belly of the curve to continue outperforming. This bodes well for 2s, 10s flatteners, as well as for 5/30s steepeners. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as our co-pilot aptly observed, even a stopped clock gets a bull flattener twice a day. It was just so close. Missed it by that much. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.